Okay, what's up everyone? This is Scott here again with a brand new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And so with one more week in the books, obviously here we have another video showing the various trades I put on this past week. And this here has been the third really good week in a row. So once we fully dive in, you'll see the various new positions I put on this past week, and also I'll talk about the positions I took off for profits. But of course, before I do so, as always, in case you are brand new to the channel, I just want to let you know that you can also find me on Skillshare as well, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out, and when you sign up for Skillshare using any of those links, you'll get a 2-week free trial. Okay, so now we can fully dive in here, and I did put on 3 new trades this past week, one in OXY, another in Kohl's, and one more in Nvidia. Now, unfortunately, it was a very busy week with work, so I was not able to record all 3 of these, but I was able to record my OXY trade as I was putting it on, so I'm going to go ahead and stop here and play that clip so you can see exactly my thought process and what I was thinking when I made that trade. Okay, today is Thursday, August 19th, and the stock I'm looking at here is Occidental Petroleum Corporation, or OXY. So these guys are involved in the exploration and development of oil and gas in the US and also other parts of the world. And there are 2 main reasons why I like this setup here. The first of which is you can see as of late, if I zoom in a bit, we've had 1, 2, 3, 4, 5 down days in a row. And so as myself being a contrarian trader, I do like to get on the opposite side of what the masses are doing. So right now the herd is just selling the stock down every single day in a row. And as I've said many times in the past, even if a stock is in a strong downtrend or in a strong uptrend, the stock is not going to move down or up every single day in a row into perpetuity, right? Even in a downtrend like this, like we're seeing now, there are oftentimes big down moves followed by a short-term rally, more big down moves, short-term rally, maybe some sideways price action, then a resumption down lower, etc. It's not just one straight shot down every single day in a row. Unless, of course, we're in a stock market crash kind of scenario, which is not the case here. So that's the first reason why I like this setup here. I do think we are a bit overdue for a short-term pullback, a short-term rally for the time being. And then also, if I zoom back out a bit, and let's focus on this area right in here, and go to the drawing tools, and we'll go to this guy right there. Let me draw a support level from where we are currently all the way back here. And there we go. So I do think here there is some potentially pretty strong support around this price point, $22 and maybe 30 cents per share, somewhere around that point, right? Because you can see specifically right here in the past, once OXY got down to this level, it shot right back up. And now that OXY is back down once again to that level, of course, we'll see what happens. The support definitely could break. Anything can happen. But I think if you do want to get bullish on this stock, now would be a great time to do it. 5 down days in a row, followed by a potential hit on a major support level. And on top of that, we also do have a slight expansion in implied volatility. You can see right there. Now, the IV rank and the IV percentile are definitely very low. This is the one thing I do not like about this trade. And so that's why I'm sticking to a purely directional kind of trade. When implied volatility is pretty low like this, it's not really a good situation to sell a strangle, for example, right? Which is selling both a put option and a call option out of the money at the same time. Even if it was a bullish skewed strangle, because again, I am bullish here, still not a great idea because implied volatility is so low. Chances are we're not going to see that much of a contraction in the short term. Of course, this spike right here could come down a little bit, and that would certainly help any option selling kind of strategy. But because in this case, I am not trying to trade the implied volatility, that's why I'm sticking to a purely directional kind of play. Right? And that's due to the fact that if I am correct on this position directionally, if we do see a short-term bounce over the next few days or weeks, that directional move alone will make for a very quick profit and I can get out. Whereas if I had a strangle on here, then as the stock moved higher, that would obviously be profitable for the put option side of the strangle, but the call option side would be losing money. So my potential profits in that case with a short strangle would likely be very watered down. So with that being said, let's come over to the trade tab here, and I'm still in the September expiration cycle with 29 days left to go. I was considering selling the 22 strike put options for about $128 in credit, but as you can see with the stock price at $22.25, that's only 25 cents away from my strikes. That's a bit too close for me, so I'm going to go to the 21 strike put options and give myself a bit more cushion in case I'm wrong. So let's go ahead and click on the bid price here. And that brings up the sell order. I'm going to sell 3 of these contracts, and we'll see if I can get filled at maybe $90 per contract. So in total, that would be $270 in credit. That's not bad. So finally, we'll go to confirm and send. Take a look at the buying power effect on this position, $975. That's fine. So we'll go to send and see what happens. And there we go, just got filled at 93. Very nice. So last step is to come back to the trade tab here, and we'll go ahead and set up a buying order to buy these contracts back if I am correct on this position. So of course, we're going to buy back 3 contracts, and I'm going to buy them back at half price. I got filled at $93 per contract, so divide that by 2. That means we're going to buy them back at around 46. And then we'll make this a GTC order, confirm and send, all done. Okay, welcome back. I hope you enjoyed that clip. And so now let's walk through each of the positions I have on in my portfolio so I can give you an update as to where everything is at. So beginning first with my US Steel position, this is a more uncommon position for me because this is a put debit spread. I bought options for this strategy. Typically, 99.9% of the time, I only sell options, but I did decide to take a small shot on US Steel, and so far, finally, on the very last day prior to the expiration, it looks like those profits are finally starting to come in. So we'll go to the charts real quick and take a look at US Steel. Already have that pulled up. Let me zoom in a bit here. So if you saw my last week's live option trading video, then you have already seen this chart. But essentially, I noted this resistance level up here, right? Because as you can see in the past, there were 2 times where US Steel got up to this price point, right around 29-ish bucks per share, and then it was repelled right off that. So for the 3rd time that this happened, right when US Steel got to around this point on August 10th or so, that's when I went into my trading platform here and bought 2 put debit spreads on US Steel, right? Because again, my assumption here was that US Steel was going to turn around and get repelled off this resistance level. Now, it did take a few days for that to happen. US Steel definitely tried to finally push above that resistance point a couple times, but ultimately it did fail. So like I was saying, today is the expiration day for that position. And fortunately for me here, I'm finally getting the move that I wanted. Now, I do not know how much further this stock is going to drop just in today's trading session. And as you can see now, US Steel is touching the 20 period moving average here in blue. And this can act as support sometimes. So I think what I'm going to do here is just go ahead and take this position off for a nice profit. As you can see, I'm up about $100. That's totally fine for me, especially given that I was down on this position by over $100 just a few days ago. So I'll come over to the trade tab now, and we'll go ahead and close this order for a nice profit. So I'm going to sell the 28 strike put option. This is the one I bought initially. And then I'm going to buy back the 25 strike put option. This is the one I sold as part of my put debit spread. So I'll right click here, and we'll go to sell. And then vertical. Scroll down a little bit here. So there we go. Down here, we're going to sell 2 of the 28 strike put options because, again, I bought 2 of these debit spreads initially. And then we're going to buy back the 25 strike put options right there. And I'll come down to maybe 120, see if I can get filled pretty quickly here. Confirm and send. And there we go. Just got filled, and I'm out of that position at 130. Totally awesome. So there we go. Even though almost all the time I would suggest and recommend you be selling options, sometimes if you do see a really good setup like this, and if you want to take a very small shot just to try and make some extra money, then by all means go for it. I did keep this position here very, very small. So in the event that I was totally wrong and I lost all my money on those debit spreads, it was only going to amount to be about $160. Not a big deal. So that's awesome. Let's come back to the monitor tab here. Next up, we have my OXY naked put options, which I showed in that short clip I recorded earlier this week. And so far, I'm down about $20 because it looks like, obviously, if we go to the charts, OXY, yep, as you can see here, OXY is continuing to push lower. This is the 6th down day in a row. That's pretty amazing. And of course, as you can see here, it did cut right through the support line that I thought I had picked out pretty well, but we'll see what happens going forward. The stock definitely could rebound and eventually use this line as support to repel off of it. Or of course, it certainly could just keep going lower and lower and lower. And in that case, I will short shares of the stock to cover my obligations on these put options. And that's something I've already done on my WYNN Resorts position that I'll show you in a second. But as you saw in that clip, my put strikes are at 21. So with the stock currently at 21.87, still nothing to do on this position. So let's come back. Next up, we have my Kohl's short strangle, which is something I was not able to show in a pre-recorded clip. So let's come back to the charts and I'll show you what I did here, KSS. So this was a very typical earnings play I made, right? You can see down here with the implied volatility charts, there we go, down here, leading up to that earnings announcement, there was a nice buildup of implied volatility, all the way up to about 66%, which is pretty high for an individual stock. And then once those earnings figures came out, which you can see right here on August 19th, boom, huge crush in implied volatility. This was the move that I was specifically trying to trade and profit on. And so the way I did this, if you come to the trade tab, very simple. I just sold the 62.5 strike call option, and then also the 47.5 strike put option. At the time, this was a slightly bullish skewed strangle. The delta on the put was a bit larger than the delta on my call option. And so if we do come back to the charts one more time, you can see once those figures came out, Kohls did definitely move a lot higher. Let's zoom in a bit more here. So this is the big green bar that occurred right after those figures came out. So directionally speaking, I was correct. This bullish skewed strangle was the right position to have on. And then of course, combined with that, a nice contraction in implied volatility. That's why so far, if we come back to the monitor tab one more time, I'm up on this position by just under 200 bucks. Very nice. So I have not quite hit my profit target yet on this position, but I am getting very, very close. Next up, we have my Nvidia strangle, which is a very similar position to my Kohls one. Let's come back to the charts here and we'll go to NVDA. So this also was a very typical standard earnings play. Now, unfortunately, this position is not as profitable as my Kohls one because one, the majority of the buildup of implied volatility for this stock was actually around the split announcement for Nvidia, right? This stock actually had a 4-to-1 split back on July 20th, it looks like. And so most of the hype and uncertainty was around that event as opposed to the earnings event. So the point being, once those earnings did come out on August 18th, there was not that much of a buildup of implied volatility. We are seeing a somewhat of a nice contraction here now, and that is helping. But also with that, the stock has moved up quite a bit. It's gone from a low of around 188. It got down to this point right when those earnings got announced and then shot all the way back up to about 204, 205. So that's a pretty big move to the upside. And even though I did put on a bullish skewed strangle here, specifically I sold, if I scroll down, there's a lot of strikes. I sold the 215 strike call option and then also the 180 strike put option. And at the time, like I said, this was a bullish skewed strangle, but now that has totally flipped. The delta on my call of 32 is obviously a lot bigger than the delta on my put of only 12. So this is now a bearish skewed strangle because Nvidia did move up so quickly. So still nothing to do here, no management needed because obviously, as you can see, my strikes are still well out of the money, but mostly because of a very small drop in implied volatility and a pretty big move to the upside. That's why if we come back to the monitor tab here, I'm only up on this position by 30 bucks. And this was a pretty hefty strangle that I sold, right? Because Nvidia is still a pretty expensive stock. So that means I am definitely still a pretty far ways away from reaching my profit target on this strangle, but just have to be patient and see what happens. Next up, we have my UAL strangle, which I've had on for a little while. There's not that much to say about this position other than we're just still waiting for my profit target to get reached. So we'll go to UAL. And let's zoom in a bit here. Again, I do apologize for all the stuff that's on my charts. I do have a lot of alerts and orders in place to let me know when stuff happens or hedge this strangle when certain stuff happens, etc. But as you can see, of late, this stock has sold off pretty much every single day in a row. And now it is getting pretty close to my short put options. So specifically on this position, I am short the 42 strike put and the 52.5 strike call. So like I said, getting a bit close to my put option here, but nothing to do yet. And then also, very interestingly, we are seeing an even greater expansion of implied volatility. I guess there's a lot of fear or uncertainty around the travel industry, especially given the new Delta variant of COVID. So that's my best guess as to why we are seeing an even further expansion of implied volatility for UAL here, which is United Airlines, in case I forgot to mention that. So I would say it's mostly because of this expansion in implied volatility. That is the reason why on this position, I'm only up about 52 bucks. So we'll just have to keep waiting and see what happens going forward. And then finally here we have my WYNN Resort strangle on. Now this one has given me a bit of a hard time because I have had to short shares of this stock as a hedge. So specifically if I unfold this tab here, you can see I am short the 92.5 strike put option and also short the 100 strike call option. And I am also short 100 shares of this stock. So I am managing this position very aggressively. And if we come to the charts real quick, let's go to WYNN. And we'll zoom in a bit here. And so here we go. This is the down move that specifically I'm talking about, which is the reason why I've had to step in and start hedging this position. right? The stock is currently at $88.40 per share or so, which is well below my 92.5 strike put. So once this stock breached my put strike, that's when I shorted 100 shares of this stock. And I have lost a little bit of money from doing that because sometimes when the stock bounces back and goes higher, you have to buy those shares back and remove the hedge. And when you do so, you will lose a little bit of money, about 40 bucks or so in my case. And the way I've compensated for losing a little bit of my credit here is I did roll down my short call option, right? So originally when I put this position on, I was short the 115 strike call option and the 92.5 strike put. But again, because I have lost a little bit of money from trying to hedge this position, I did decide to buy back the 115 strike call option for a profit because again, the stock is moving down. So I bought back this one for a profit and then sold a new call option closer to the stock at the 100 strike to take in extra credit. So at this point, this stock could go to zero and I could still walk away with a profit on this position, which is very nice. And the reason being, of course, is every dollar I will lose on the put option if the stock does continue to go lower, I will actually make back on my short stock position. So we'll see how this one works out. Prior to this, I was trying to hedge my short option positions by buying or shorting stock in increments. Like for example, in this case, I would try to initially short 25 shares of stock. And then if WYNN kept going even lower, then I would short another 25 shares and then do it again and do it again until I was fully hedged. And while that can certainly work, help mitigate your losses, as I experienced in cases like Virgin Galactic, where the stock went from like 25 to 60, right? So for instance, let's go to the SPCE charts. When this big move happened, I was short some naked call options. And even though I did mitigate my losses by buying shares of stock in increments, this massive push higher still blew up my position pretty badly. And same thing with TAL. Right, this stock I sold some naked put options on a while ago, and as you can see, this stock went from 40 when I put on those puts and fell all the way down to 5, although I did take my position off around this point, around 20 bucks per share. So very same thing, because the stock fell so quickly and by so much, shorting the stock in increments definitely helped reduce my losses quite a bit, but the losses in the end were still pretty significant. So that's why now I'm going back to a much more aggressive management strategy by hedging these positions by buying or shorting 100 shares immediately once my strikes get breached. This was something I tested out a while ago and it did work very well. And I thought I could improve it by instead hedging in increments instead of hedging the full thing at once. But as I just explained with Virgin Galactic and TAL, that did not work out as well as I had hoped. And finally here, let's go to AMD. This was a stock I had a position on earlier this week. Specifically, I sold a naked call option, I believe right here on the 5th update in a row. Basically, I was banking on this massive push higher on reversing because this to me seemed pretty unsustainable, which of course, as you can see now, it definitely was. So after applying a bit of patience, I was able to take this position off for a full profit and walk away. And of course, you can take a look at my previous live option trading videos to see how I put that position on. And then alongside that in RCL or Royal Caribbean, I did have a short strangle on this stock as part of a earnings play. So right here, this was the earnings announcement that I was trying to profit on. And once those figures came out, we did see a pretty big push higher, but that has pretty much all been undone. So ultimately what that amounts to is a very small net change in the price of the stock combined with a somewhat moderate decline in implied volatility. And also you can't forget about time decay as part of a option selling strategy. So all three of those things combined allow me to take off this position for a full profit this week as well. And so with that being said, that's going to do it for this video. I hope you enjoyed it. And please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my Skillshare courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.